Hello everyone and welcome to No Option Antics, and what we'll be discussing here in this segment are call options and what a call is and the little elements about the call. So let's describe what a call option is. A call option is an option that simply gives you the right to buy something at a certain price by a certain amount of time. Now let's give you an example of what that represents. Let's say you own a house, and let's say this is your beautiful Monopoly house. I think we should give Parker Brothers a little nod on that house there. And let's just say, for example, that your house is selling for $100,000, and you'd like to buy that house. So what you do is you don't want to buy it until you really check out the area, see what's going on in that local area. So you approach the owner and you say to the owner, hey, listen, take your house off the market for a month. I'll give you $2,000. Now, if the owner accepts that, what you now have is you have a call option. You have the right to buy the home for $100,000. You have paid $2,000 for the right to do that, and you have 1 month for your option to be valid, which means any time during the month you can buy that home for $100,000. So that's all a call option is. It's the right to buy something at a set price for a set amount of time. Now there's a couple things that can happen, okay? You have to understand that these call options are basically like coupons. If you have an option or a coupon to buy the home for $100,000 and later on the house is worth $150,000, would you use that coupon? Absolutely you would. Conversely, if you had the right to buy the home for $100,000 and the house was worth $75,000, would you use the coupon at that point? Well, of course you wouldn't. Then the option would go out worthless. So let's talk about what can happen. All right. Well, if the value of the home goes down, you have the option not to buy it. So let's give you an example. Let's say that you had this option to buy this home for $100,000, and let's say that you were going to check out during the month, you're checking out the local area, and you're walking up the street, and as you're walking up the street, this big van comes and pulls up in front of the home. And all these guys pile out, and they've got big yellow suits on with a radiation symbol in the center. They're heading towards the home that you want to buy. Well, do you think at this point that the home is going to be worth that $100,000? Well, more than likely not, because nobody's going to want to buy that nuclear home for $100,000. Maybe it's only worth $50,000 now. Well, you've got the option to buy it for $100,000. Obviously, you wouldn't use the option at this point in time. What would happen then is you would lose that $2,000 that you put up initially. That would go to the owner so he could throw a big party in his nuclear house. Now, the other side is that if the house goes up in value, let's say it's 2 weeks after you bought the option, and you go down to the neighborhood of the house, and you're checking things out, and you find out from some of the neighbors that what they are doing is they're going to be building one of the most spectacular golf courses in the back of the home. This house is going to be on the 18th green. They're going to hold PGA events here. Well, obviously the home's going to be worth more money. Let's say it goes to $200,000 in value. Now at this point you still have the ability to buy the house for $100,000. So you could what's called exercise your right, get the house for $100,000 and turn around and sell the house for $200,000, therefore making your $100,000 of profit minus the $2,000 that you initially put up. You can do that. Another thing that you can do is you could also sell your option. And think about this. If you have the ability to buy something for $100,000 that is now worth $200,000, think about what the value of that option will be. Well, it'll be the difference between where you could buy the house and where somebody else could buy the house. So if you could buy the house for $100,000, everyone else would have to pay $200,000. That option would be worth the difference, or $100,000. And that's really how options are designed to work for the general public. They're designed to be bought and later on sold. Okay? So an option gives you, if the option gives you a benefit, then you want to use the option. Otherwise, if it gives you no benefit, there's no sense in using that option. Here's a risk graph of what a call option looks like. Okay, long call, long means ownership. This is a long call, a long $45 call. So our strike price is at $45. And here we show an example of buying this option for $5. Now you'll see that the most I can lose on this position due to my risk graph is the $5 that I put into the position already. But you can see that as the stock keeps going up in price, looking at the numbers along the bottom and looking at how the prices of the stock could go up, you can see that I make more and more money on this particular option as the stock goes up, obviously up until infinity. The only difference between owning the stock and owning this is that I have much less risk in owning the call, but I do have to overcome the amount of money that I put into the trade initially, or the $5, which is why you see that at the $50 mark I break even, because I have the ability to buy the stock at $45. If the stock were trading at $50, there would be $5 of real value, yet I paid $5, so that just compensated for the $5 I paid out. Let's take a look and let's do a little example here of intrinsic value, real value of an option. Let's say the stock is trading at $23. And we've got a $15 call, and we've got a $20 call, a $25 call, $30, and $35. Let's figure out what the real value is. If we look at the 15 call, the 15 call gives us the right to buy the stock at $15. Well, if the stock was trading at 23, yet you could buy the stock at 15, well, that gives you a $7 advantage. That's the real value of that option. If you were looking at the 20 call gives you the right to buy stock at 20. Yet if the stock were trading at 23, you would have a $3 advantage over everyone else. That's the real value. The 25 call has no real value, because why would you use an option to buy stock at 25 when the stock is only trading at 23? The 30 call, that has no value either, because why would you use your option to buy stock at 30 if the stock were trading at 23? That also has no real value. As well as the 35 call. There's no real value in those options. So there you go. There's your overview of what a call option is. Now, calls also are traded in contracts. They're not traded individually in individual shares. So generally in the U.S. what you will find is that your option contracts control 100 shares. And if you're looking at other markets, such as the UK and Australian market, generally they will control 1,000 shares. So those are your option contracts, and those are your call options. Join us for more education at nooptionantics.com, or you can contact us at info@nooptionantics.com. This is Peter Zamaya, looking forward to seeing you again. Thank you.